Hey guys, it's Rudy for Bester Investors, Mr. Oxy, coming at you from West Palm Beach, Florida today. And what I'm going to do is talk a little bit about why you should absolutely avoid buying stocks, especially when you listen to people like me, because you're just going to lose all your money. But then at the same time, I'm going to give you 5 reasons to invest. So let's take it away and see how this one pans out. In the first place, there are probably many compelling reasons as to why you should avoid buying stocks, but I thought I'll whittle it down to one. To be fair, one A and B. So maybe that would be two. Just by way of background, why are stocks called securities? If stocks were actually called by the most common universal trait, they would probably be called risks. So why did Wall Street call them securities? Because if they called them risks, no one would buy them. So today, when we think of registered securities, we think of small and mid and large cap stocks, ETFs, bonds, mutual funds. Those are the most common ones we think about. And all of them have one inherent trait, and that is called risk. But what does Wall Street call them? Securities. Isn't that just a funny dichotomy? How about diversification? People will say, and I'll just skip down to the bottom over here, if you diversify, you'll be all right. But what are they trying to tell you? That you should diversify into a variety of different stocks or equities. In other words, the things I just mentioned on the previous slide. They will tell you, diversify, and I have done the same, by the way, so I'm not blaming anyone here. I'm just talking about stock investment in general. Diversify across various industry segments. So get some energy stocks like Oxy. Get some financial stocks, especially cheap ones like maybe Wells Fargo. Get some pharma stocks, especially some pharma stocks getting crushed by a variety of different factors, including President Trump saying we're going to make sure that pharmaceutical prices go down. But a nice big one that you can buy at a discount like Pfizer. In other words, diversify across a variety of different verticals to start with, and then maybe hold a few different asset classes within your portfolio. So in addition to the diversification across different industry segments or verticals, you can also own a bit of gold and some cash and some government bonds and treasuries and things like that. But regardless of what it is that you hold, all those equities are subject to fluctuations, uncertainty, and a whole variety of other things, including recently we saw COVID-19. Like, who would have thunk, huh? A pandemic will just crush the market. What did we go down? About 38% or something like that? There are no profitable return guarantees, not even in the long run. Well, history kind of shows us something that's slightly different in terms of stocks over the long run. We'll get back into that one in just a second or so. And to make matters worse, nowadays you can say, be woke and go broke. People are telling you to invest in all kinds of stocks with social causes, especially green energy stocks or the Green New Deal kind of stocks. Hey, you know what? If you want to be woke, that's great. Just be prepared to go broke. So why should you invest? So what I thought I would do is I would just put together 5 quick reasons why you should invest. And as usual, I cheat a little bit because I'm going to say 5 reasons, but then I'm going to give you a couple of bonuses right at the end. Number one, grow your money. This is probably the most common and the most simple reason why people invest money in the stock market. Over the years, firstly, there's not a lot of else that you can invest in the first place, but over the years, many people have generated a great return. And if you watch this video, which you'll easily find in my library of videos if you subscribe, how to make money in the stock market, you'll get an educational video that kind of shows you how you can grow your money and achieve a return on your investment of sort of 7 to 10% per year. I also explain in that particular video how even an underperforming stock like Intel gained 7% per year over the last, I think it was 10 or 15 years. No, 10 years, yeah. Doubling your money in just 10 years. To be fair, I shouldn't call Intel an underperforming stock because 10 years ago it was trading at about $20 And very recently it hit a high of almost $60 before it pulled back to $50 per share, and that's how it kind of got to the doubling or average of 7% per year, doubling over a 10-year period. It did much better. Coronavirus crushed it, and then their last quarter's earnings were so bad, the market just crushed them anyway to punish them. But if you're interested, look up this video, how to make money in the stock market, in my library of videos, and take a few minutes to watch that one. Over time, number 2, over time, stocks go up. So I just mentioned that just a minute ago. Yes, over the past 100 years, we have a very long history of even the stodgy old Dow. Despite all the crashes, pullbacks, and bad performance, presidents coming and going, all that kind of stuff, the Dow has gone up dramatically over the last 100 years. In fact, by way of an example, if you had invested just $1 in small cap stocks in 1926, it would be worth nearly $40,000 today. Now, of course, you would be 120 years old, and then you'd be saying, what on earth must I do with $40,000 today if you're 120 years old? And in addition to that, you could quite realistically, logically, and rationally counter and say $1 in 1926 was equal to maybe 1 week or even 1 month's worth of wages. So get out of here, you crazy dude. But anyway, in reality, small cap stocks over that period of time, 100 years since 1926 to today, $1 would be worth about $40,000 just on averages. Risk and reward, right? If you had $1 in 1926, you probably would have felt wealthy. If you invest in stocks, the odds are in your favor that over time the market will go up and earn you some healthy returns. Did I say odds? It kind of sounds like speculation or gambling, huh? Number 3, compounding. If you're not very familiar with compounding, please look at this video in my library. It's the same video I just highlighted a few minutes ago. It's how to make money in the stock market with 5 basic rules for beginners. If you earn a good, steady, average return on your investments over a long period of time, your investment will grow way bigger than you can imagine. Because $100 might become $110 after 1 year. But in the second year, you are actually getting the same 10% on $110 and so on. And 15% as an average growth will double your investment every 5 years. If you are 25 years old and you have managed to save up $10,000 and you just leave it there at an average compounded growth rate of 15% per year, then 10,000 will become 20, will become 40, will become 80, will become 160, until by the time you get to the age of 50, after 25 years, $10,000 will be worth $320,000. Did you know, just as a fun fact, Warren Buffett, who is one of the wealthiest people in the world, who is now obviously in his late 80s, only really started making money, big money, in his 50s. So there is hope for all of us. And on that smiley, happy note, even me. How about number 4? Cash loses value. I know you're hiding some money under your mattress or somewhere, right? If you save $1,000 this year under your mattress and you keep it there for 20 years, assuming you don't change your mattress, it won't be worth $1,000 when you take it out. Think about it, guys. I mean, like $1,000 this year. Let's assume it costs you $1,000 for a month to pay your rent. In 20 years from now, you might be lucky to pay $1,000 for a week in that same apartment that you might be renting. And anyway, if you put your money in the bank, which is probably better than the under the mattress, what do you think the bank does with your money? Why do you think in every city that you visit, anywhere in the world, the most beautiful buildings are owned by banks and of course the government, but they get free money because they take ours. But banks and financial institutions like insurance companies, they own the most beautiful properties. Guess what? They buy them all with your money. If you put all your cash in the bank, they take all your money, invest in the stock market and get a great return, and at the same time invest in real estate, which you can't afford, and they just get richer and richer as time goes on. But more importantly, inflation. is going to eat away at your cash over time. Inflation is the equal of reverse compounding, and that's one of the reasons why your money is worth less and less and less as time goes by. Look at JP Morgan Chase as an example. This is a 10-year chart. I'm sorry, it's a 5-year chart. 5 years ago, JP Morgan was trading at about 60 bucks and currently it's trading about $100. If you put your money into JP Morgan Chase, into a safe savings account or a guaranteed investment certificate account or whatever you want to call it, your account interest rate today on a savings account is 0.01% average percentage rate per year. In other words, it is zero. And what do? They take your money, they invest it, and turn $60 into $100 over 5 years. And that's after JP Morgan had this massive crash because of the coronavirus pandemic. So if you're putting cash in the bank in a savings account, it's the same as putting it under your mattress. You are earning zero. Number 5, stocks offer a better return than almost anything. Small stocks obviously always outperform, but they also take the biggest hit when there's a big problem like the recent coronavirus pandemic. But if you look at the actual performance of stocks, small stocks, this is really tiny for you up here on the screen, so I'm just going to read it very quickly. Compounded annual return, small stocks 12%, large stocks 10%, government bonds 5%, treasury bills 3%, inflation is tracking at 2.9. That's what you lose. So you lose about 3% on your cash, and you can make about 3% on treasury bills. So if you put your money into treasury bills, it's a wash. What about other types of investments? Most of the people watching this video will not be able to get into private equity or into venture capital because it requires quite a bit of cash. There are some funds that you can invest into that give you access to private equity and venture capital, but most of you cannot possibly qualify to get into private equity or venture capital. However, you could invest in hedge funds. Many hedge funds have a minimum investment requirement, and they also have a minimum holding period. Often they tell you if you invest, you cannot withdraw your funds within a period, like for instance 2 years. You may say, what is a hedge fund? And there's a video in my library as well that will explain what a hedge fund is. In fact, you and two or three of your pals can actually get together and start a hedge fund today if you feel like it. Of course, many people invest in real estate. I don't particularly like, I have some real estate investments. I don't particularly like real estate as an investment category. And the reason for that is just because I absolutely treasure my mobility. And real estate is a fixed investment that kind of locks you into a particular geography. So I'm not really keen on real estate, even though I own some commercial property and residential property too. And there are other things like collectibles, wine, art, stamps, etc. I do like investing in some of these collectible type investments, and the reason why I like investing in them is exactly for the same reason I just mentioned. I don't really like real estate. These investments are actually mobile, and you can take it with you wherever you go, depending on what it is. So, for example, if you have a very good, valuable piece of art, you can box it up and take it wherever you go. So I like the alternative investment asset class of collectibles because it's mobile. And the bonus round, as I promised at the start. So actually it's 2, so I'll say bonus round A and B. Stocks are easy and simple to invest, and you can, for the pricely sum of a few dollars, $10, $20, $50, like if you want to buy a piece of Oxy, you can buy it for $10 a share. But make sure that you research and invest some time to make good investments decisions, which, by the way, is what you're doing right now. Stocks are fast, easy, and cheap to trade. Real estate and many alternative investments are not. Of course, one of the primary objectives is also that it should be fun. If you're not having fun, then why are you doing it in the first place? You will learn about businesses, their CEOs, and their executives, and taking time to study a company can have a huge impact on your financial future and even your personal career. As you learn what makes certain businesses and companies and CEOs successful, you can copy and you can just emulate whatever it is that they're doing that's successful, And you can also try to avoid their errors, which means you can actually enrich your own career by just observing and learning from the CEOs and their executives. And don't forget that you will feel sad when your stocks go down and feel happy when you see your stocks going up. That's just human emotion, but at the same time, you should still have some fun. Guys, that's it. Or stealing from Warner Brothers. That's all, folks. I would really appreciate it if you hit the subscribe button if you like my videos. Some of them are educational, like this one. Many of them are very specific, like my video library on Occidental Petroleum and other energy stocks. But what I've given you here is one compelling reason to stay away from securities and several ridiculously logical reasons why you would like to own stocks or why you should own stocks. So on that happy note, this is Rudy for Bester Investor, or otherwise, as some of you call me, Mr. Oxy, signing off, saying take care, have fun, have a good time, and stay safe. Hit the subscribe button. Thank you. Bye-bye.